You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is real estate investment expert, Edna I. Now, Edna is a former financial advisor that got her first initial taste for real estate investing a short 10 years ago. Since then, Edna and her team have built a portfolio worth in excess of $60 million, primarily consisting of multifamily units, and for the most part, using none of their own money. So I'm very excited to get onto the show with Edna, but before we do, I just got a few important updates I want to go through with you guys very quickly. As I've been mentioning, for the last couple of weeks and months, we're launching our second mobile home park fund, appropriately named Mobile Home Park Growth and Income Fund. We had great success with our very first mobile home park fund that we launched back in 2017, and we look forward to capitalizing on the incredible opportunities that are existing out in the marketplace, but also in our pipeline. These are opportunities that we currently have in contract and that we're working to get in contract. So if you're an accredited investor who has an interest in partnering with us on these deals, please be sure to go over to our website, sunrisecapitalinvestors.com. You can go ahead and sign up for our secure investor portal. And this will essentially place you in the first to know basis and allow you to somewhat proactively schedule a time to speak with me and my team more in depth about this opportunity that we have here. And then we also set up a specialty phone line where you can actually call in and talk to us directly. That phone number is toll free. It's 833 cash flow without the O. Again, 833 cash flow without the O. We currently have 8 parks in contract right now, and like I'd mentioned, our pipeline's in good shape. It's got a lot more deals coming in. So you guys have been listening to this show for quite some time. You probably listen to a lot of our other podcasts. A lot of you are experienced real estate investors, and as you already probably are aware, the money in real estate is mostly made when you buy correctly going into the deal. Okay, it's made in the front end, and that's one of the many areas that our team excels at here at Sunrise Capital Investors. And we'd love for you to join us on this journey. I'm going to say this. I'm going to make this comment, and it's pretty bold, but I do believe that we are hands down the best in our space at sourcing off-market deals, and that is the name of the game today. Anyone can go to a broker and you can compete against everyone else in the marketplace for that same deal and let it get bid up, 10, 20, 30% above asking. That's easy, and you'll end up paying too much for the deal, right? You won't be making the profit on the front end, like I said, going into it. We spent many years basically building a proprietary database of every mobile home park throughout the country, and that's where our secret sauce is. We're incredibly experienced with direct-to-owner marketing and do a great job at sourcing off-market deals. Again, get in touch with us. You can go to our website, sunrisecapitalinvestors.com, or give us a call, 833-CASH-FLOW without the O. In addition to that, guys, we're seeking additional opportunities. Our pipeline is big, but we want it to be bigger. So if you're out there on the hunt looking for deals, whether it be mobile home parks or shopping centers or multifamily properties, if you're out there looking and you just happen to stumble across something that seems like a decent deal, a mobile home park deal that's at least 60 spaces in size, maybe it's something that you want to take down on your own, but you don't have the track record or capital, we're open to speaking with you about a partnership. Or maybe you're just looking to flip it for a fee. We would love to put a big fat finder's fee in your pocket and take that off your hands if it's a deal that fits our criteria. You can email me directly, kevin@kevinbupp.com, and let me know what you're working on, and we'll set up a time to jump on the phone together. We can handle deals as large as $25 million. We can handle portfolio deals. We can handle just about everything. So if you find something that seems remotely interesting, be sure to reach out to me. Again, kevin@kevinbupp.com. Now, guys, without further ado, I'd like to welcome today's guest for our show, Edna I. Edna, how are you doing today?
I'm doing great, Kevin. Thank you very much for having me on.
Thanks for joining us here today. And I'm excited to dive into your story a little bit. Everyone's got a different story. Everyone's got a different path that they've taken to reach a success or reach the point they're at in their career at this point in time. And so I want to learn that from you. And I want to dive deep into the story. But I guess what I'd like you to do before we get into the real estate component of it is maybe back up in time a little bit and let us know in a former life. I know you were a financial advisor, so tell us a little bit about that former life and how that guided you into real estate investing.
Sure. First of all, I want to congratulate you on your mobile park funds. They sound very, very interesting.
Thank you.
I wouldn't mind hearing more about those. We get some opportunities here in Canada, so I might even be able to share that with you because I know there's really good cash flow and stuff like that. So excellent. But my background, so I started working as a financial advisor, selling mutual funds and life insurance. And you know what? I really enjoyed it. Had a very successful practice. Probably never made under $250,000 a year once I actually got going in my second year. It was good. It was good to me. I enjoyed it. And then, I think it was I think it was 2006. We had a big market correction. And so my husband and I just thought we'd diversify a little instead of having all our investments in mutual funds, that we'd look at maybe getting a rental property. So we signed up for some classes and got introduced to Robert Kiyosaki, who I'm sure you're aware of. And we learned about the cash flow game and buying properties for cash flow. And you know what? Within a very short period of time, once I understood real estate, I couldn't sell mutual funds anymore. It was like, I just couldn't. I couldn't do that to my clients. Lots of people ask me, well, did your clients follow you over to real estate? You know what? A few did, but I think I did too good of a job on selling them on mutual funds because most of them didn't. I told the same story for the 15 years I was selling mutual funds, and I think still most of them are there. But when I understood all the profit centers of real estate and cash flow and mortgage pay down and forced appreciation and all that kind of stuff, just couldn't do it. So within 18 months, we had built a 50-unit portfolio, primarily with investor capital, and we were cash flowing over $5,000 a month, which was our 5-year goal. And I knew if we were able to do that part-time, we could do a heck of a lot better full-time. And like I said, I couldn't sell mutual funds anymore, and I thought my income would probably start going down. So I sold my practice 2 years from the date we bought our first property.
Wow.
Never looked back. We've now got almost $60 million in portfolio just ourselves. I also have students that I work with, and started that 4 years ago. So we've doubled the size. We're now at 130 as the whole group. So that's really cool. We do what you do. We look for cash flowing properties only. We totally believe that it makes a big difference when you buy, and also that we get off market deals. Like very seldom have we bought anything through a realtor. The odd time, we bought most of our stuff privately through networking and networking with other investors in the same space as us. So that's a little bit about my background story.
Well, very exciting. And you're right. I mean, off-market deals it's where it's at. And it takes a lot more effort and energy and dedication to really understand that side of the business and be consistent with it. It's much harder to be consistent with that than it is just picking up the phone and calling a real estate agent saying, hey, can you go ahead and scour the MLS for me? Exactly. We just say once it hits MLS, it's probably not a good deal any longer. Well, that's it. I mean, the perfect case in point is we've got 8 mobile home parks in contract right now that we're going to be moving into the second fund here. And of those 8, 7 are direct off market. I mean, it's us going direct to owner. Actually, one of those is a referral. So one of those was actually kind of like a bird dog type situation, but still off market, not listed with a realtor, no broker involved whatsoever. The one that was actually listed with the realtor, this is a great example of the story, is that it came out on a Friday, listed at $3.35 million. And actually, based on the executive summary, I was like, wow, this is actually priced normal. Like, I'm not used to seeing like things come out of this quality at a reasonable price. Yeah. And I knew that immediately his phone was going to blow off the hook. And so I called him right away and said, hey, I'm not going to waste your time. I mean, I'm going to go ahead and write up an LOI for full price. Okay. I mean, and then he said, okay, that's fine. And then like later that evening, I sent him a text. I was trying to get some information about the seller. And he didn't respond to me. I said, hey, I want to get this LOI over to you. And then the weekend came, he didn't respond to me. And I'm like, I know it's happening. He's probably got like 80 calls in the matter of a day, probably more than that. Of everyone else is willing to probably pay full price as well, if not more. Yeah. And so Monday comes, I call him first thing Monday morning. I said, and I'm not going to give his name here. We're still in contact, but I said, hey, you didn't call me back, man. We had a good conversation Friday. He's like, Kevin, I'll tell you, I've literally got, I've got offers, many full price offers, but it's up to, it was like 3.45 or something. So it was 100,000 more than what asking. And he's like, but I know I've got one of these guys that's willing to go up to like 3.55. And he just told me to kind of like, let him know if it needs to go to that point. And I'm like, this is a joke. This is why I buy off market. I do not like we didn't overpay for it. We still, it made sense paying a little bit more for it. We did get the deal. And it's funny, but we dug into it. And we're just in the middle of a renegotiation right now on it based on some findings. And anyway, I guess the point of that story is, the market is crazy right now, and there's always a buyer out there willing to pay a little bit more than you are for a deal. And so if you're just going to rely on going to brokers, I love brokers. They play a great role, but when it's a seller's market, man, forget about it. I mean, if you want to be stealing property, you're not going to do it by going to a broker. And so I like sourcing off-market deals. Point of the story. Learn how to source off-market deals. So let's move on here. I don't want to beat a dead horse with that. Sure. Off-market deals are the way to go.
They are.
So talk to me about, I like to set the foundation. So talk to me a little bit about your first property, your first investment that you and your husband made. Was it a multifamily property, or was it just a single family? Give me an idea what that looked like.
The first investment was actually a condo. We were scared of everything. We had our own house, and we knew that there was always things that could go wrong. So our first purchase was a condo, and we're also scared of tenants. So the funny part of that story is my oldest daughter, because I was a single mom, Kevin, until my husband and I got married. I think I was almost 40 by the time we got married. But my daughter was a young adult already by then, and she was living in the condo. So when the realtor showed it to us, I said, oh, how many of these are for sale? And he said, well, a few of them, but not all. It was an apartment complex that had been changed to condos.
Okay, yeah.
And so I pointed to the one my daughter lived in, and I said, is that one for sale? And he said, yeah. And I said, well, then I'll buy that one, because I already know I got a good tenant, right?
Yeah, right.
He was taught to always pay her rent on time, so I knew that that wouldn't be an issue. And then a couple of days later, I found out that the people living right beside her had lived in that condo for 17 years. And we thought, okay, well, what the heck, we'll buy two. So we used the equity out of our home in our market. I think it was kind of like your market is right now. It was hot. Our property had almost doubled in value in a 5-year period. So we took the equity out, bought those two properties. We were able to refinance them in a year, pull all our cash out. We still own them to this day. And that's how we got started. But you know what? It was our third property that really got the ball rolling. And that property was one where we got it with none of our own money or our own equity. We had we'd been talking to this lady who was fixing up a duplex, and we'd made her an offer, kind of a low ball offer, and then a little bit higher. And finally she said, I just think I'm going to get, because of course that's kind of market it was, I think I'm going to get full price. But if I don't, I'll come back to you with your offer. And so we ended up, we did do the full price offer. It was $160,000, but she put the down payment back in the deal. So it ended up costing us no money, just the legal fees, which was like $2,500 on a little house like that. And, again, we own that property to this day. Our market's a little bit down right now, but for 5 years in a row, we cash flow that property over $1,000 a month. So sometimes when people say, like, do you ever just get normal deals? I go, oh, yeah, we buy normal deals all the time. But again, it's got to make sense. We had no money in that deal. So we could afford to pay a little bit higher. The vendor gave us a vendor take back, and we had her paid out, I think, in like 3 years. And yeah, a really good cash flow. So we made $60,000 on that property in 5 years. So the fact that we probably maybe overpaid a little bit in that market, maybe $4,000 or $5,000, didn't hurt us. But you can only do that on long-term holds. If you're doing any kind of flip ship, be careful with that.
Yeah, absolutely. Okay. So talk to me about the path that you took to get from that the first two condos and that first dupe to owning $60 million of real estate personally. Talk to me about that progression and what that looked like.
Sure. Well, after a while with single family homes, and we were pretty lucky when we started 10 years ago, we actually got 15 houses between our personal name and our corporation. But then we were dried up. We could not buy anymore. We couldn't get mortgages. There was that limit. So we started talking to a realtor at that point, and he says, well, why don't you buy an apartment building? And I said, well, we can't buy an apartment building yet. We don't own enough houses. That's what most people.
Sure.
And he said, oh, no, you can. You can. He says, you guys got a decent net worth. You both have, good incomes. They don't look at your income. So we started buying apartment buildings that way. And what we found out is apartment buildings are no harder to buy than houses, no harder to own. Having 15 houses, we're kind of spread out around our city. You get 12, 18, 24 units under one roof, one mortgage, one property tax, all that sort of thing. And you've got that many more people paying your mortgage instead of just one person.
Yeah.
So that's how we moved into the multifamily.
Well, being that you're in Canada, and I just learned this not too long ago. Here in the States, obviously, one of the attractive factors of residential investing are the loans. The long-term amortization or fully amortizing 30-year type loans. And my understanding is in Canada that doesn't exist. That even residential loans have balloons in them. Is that the case? Or I forget where I read it or heard that.
You know what? Not balloons, but we'll get 20, 25-year amortizations with their houses. Decent rates, under.
But they'll reset. They've got to reset.
Every 5 years, you got to renew. They're not 30-year terms,
Okay.
5-year terms.
Got it.
So depending on what's happening in the market, that could hurt you. Yes.
Yep. So it's not a fixed rate. It's going to reset every 5 years. Gotcha. Yeah. Which is very common in commercial, here in the States, and in residential, you just expect to get a fixed 30-year term. And so, at the end of the day, when you compare in Canada, the risk associated with investing in single family, and so as far as like the fluctuation that might exist in the financing side of things, you might as well jump into commercial or multifamily larger deals, right? Because you're really assuming the same risk at that point, as far as from a financing standpoint, right?
Yeah.
Interesting. Okay. Well, talk to me about when the time came when you really got, I know that you've done a lot of this with none of your own money. And so I'm assuming that you've syndicated a lot of these deals. And talk to me about that point in time where you really went out and put together the plan saying, okay, we're going to go from the size we are today. I don't know when this discussion happened with you and your husband, but there was probably a point where you're like, hey, we've acquired X number of properties, but like, how are we going to double that? How are we going to triple that? And then when you had that discussion, what was that plan? What did it look like?
Well, we started, like I said, with investor capital right away. So after we couldn't get any more mortgages in our name, we started bringing in joint venture partners. Okay. And we bought 12 more duplexes in a year. Okay. So each duplex costs between $70,000 and $90,000 for a down payment. And when we started looking at apartments and realized, how much money we raised, because we really just did do them one at a time, started thinking, well, heck, we may as well just move into multifamily and put 3, 4, 5 investors in a multifamily. It would be less work. We don't have to worry about everybody qualifying for the mortgage. We qualify as a group. And that's what made it easier. And, still today we can buy multifamily left and right as long as we have the capital. There's no limit on them. They just keep letting us buy. So.
Do you feel that your structure is a little different with your investors on the bigger multifamily stuff you're doing versus what it looked like back when you're just raising capital to do duplexes here and there?
Yes. We used to do 50-50 with our partner, and they had to hold the mortgage. They had to provide a reserve fund and all the legal fees. So all the costs were on them. And then we actually started splitting cash flow right from day one. And then what we did is we refinanced when the term came up, and the rest of the balance was paid out to them. And then at that point, we could either decide to keep it or sell it, whichever way we wanted to go. And they maintain their 50% ownership. But what we've done with apartment buildings is, because like you, we kind of find those off-market deals. So there's work involved with those. You're always learning, you're always searching. Your network helps you out a lot. Lots of people just don't have access to those deals. A lot of people, even in real estate, don't have access to those deals because they don't know how to find them. So when we find those deals and they're, extremely lucrative, we'll own 60% of it and have our investors own 40.
Mm-hmm.
And what we do is we work to pay our investors back as quickly as possible, because we don't share in the cash flow until they're paid back, because we don't put in any money. So we pay out all the cash flow to the investors. And if we still owe any at the 5-year term, then we refinance and pay them out the balance.
Gotcha.
But lots of our deals, we pay them straight out of cash flow.
Yep. So that's your carrot. That's your dangling carrot to get there as fast as possible.
Yeah.
So do you, I was going to ask a question. I just lost my train of thought of what it was I was going to ask you. Preferred returns. I mean, do you have preferred returns factored into your structure? And on top of that, being that you're not taking any of the cash or distributions until they're made whole with their initial investment, are you guys factoring in like an asset management fee or anything like that?
We'll take an upfront acquisition fee.
Okay.
And one of my partners, not all, but one group of partners, they're actually property managers, so they'll manage the property as well. We usually outsource the property management.
Mm-hmm.
But no, we don't give a preferred return. What we do in the first 5 years is give them return of principal. And then after their principal's all paid back, they still maintain their ownership. Yep. That's when our cash flow cuts in. So we'll then get 60% of cash flow. They'll get 40. And if the deal's even more lucrative, like if we're able to, say, pay our investors out a lot more quickly, we've done it as fast as 18 months just through forced depreciation and stuff,
mm-hmm.
then they get a lower ownership, because again, that's all work and the onus is on us to
Sure. Yeah, I mean, every project's a little different than the next, and so that's why actually what I want to move into talking about are the types of multifamily properties you guys are going after today. I mean, are you really going after the big value add heavy lifting plays, or do you guys look for more stabilized deals?
We'll take both.
Okay.
A lot of it just depends on the how the numbers work. For example, right now we're working on one 41 units in northern Saskatchewan, about 6 hours from where we live. It's actually my hometown, so I'm very familiar with the town. But stabilized, very stabilized, 100% full, no deferred maintenance, none of that. But we got a really good deal. We're paying 30 to 40,000 a door less in that small town than we're paying in the city. And the rents are the same, and vacancy rate is lower. So I'm not scared of small towns. Some people are, or I should say small cities. This is a city of about 6,000. And I'm not scared of them. I know that. I know the industry up there. I know the economics. I still have 3 brothers that live there. That town's not going anywhere. So we feel very confident buying into a market like that. And yet at the same time, we're buying in the city and we're paying $120 a door, and they're average deals. But we seem to be getting lots of opportunities right now, because there's a lot of people retiring in our area. They've had a good run and they're ready to sell out. And so we're making some pretty creative deals, getting lots of vendor take back, stuff like that, because people who own real estate are kind of predisposed investors. They're some of our best investors, because why would they take their money out and put it into a bank when we can pay more and it's backed by an asset, right?
Yep, absolutely. Good deal. So you bring up a great point about the small markets, and it really comes down to just knowing your market. It doesn't really matter what size market it is. I mean, just know the economics that drive that particular marketplace. And so we're the same way. I mean, we will buy, we almost bought a community, this is a number of years ago, a mobile home park. It was in Iowa. And I think that the population of that town was about 6,000, probably 6,000 or 7,000. So very small, about the same size as the town that you're buying this 41 unit in. And it was like 40 minutes from the next largest town to where all the shopping and entertainment was, all the chain restaurants and things like that. And then the other direction was like an hour away. But what you need to understand about Iowa is it's literally a very flat state for the most part, where the towns are very sporadic and spread apart. And so the normal travel pattern for folks is that a 40-minute drive to them is equivalent to like a 10-minute drive for me. Like they're just used to it. Like it's expected. And so most people lived in a small town, although there weren't a ton of jobs there, the industry was 40 minutes away, and about 80% of them actually commuted to this larger city, but liked the small town atmosphere. And so, yeah, you again, just got to understand your market, got to do the research, got to do the due diligence. That's an area where you cannot skimp is on the due diligence side.
Absolutely correct.
Yeah.
Absolutely correct.
So,
And, one of our I call this deal a home run, so I wouldn't mind telling you about that if you don't mind. But
sure.
another one in northern Saskatchewan, another 3 hours north of the one I was just telling you about, 144 units we bought, 40-some thousand a door, I think 41,000. 2.5 years later, we were able to refinance, pay out our investors all their capital, which was $1.2 million. We still hold the building today and cash flow we personally cash flow about, I think it's around $18,000 a quarter, so over $6,000 a month on that one.
That's fantastic.
Yeah.
Yeah. So I meant to ask you about that 41 units. So something like that. And I know that might be classified as a home run and might be somewhat of an anomaly, but let's just talk about that one for a second in the smaller town. What kind of cap rate? Because you said that one was more of a no deferred maintenance, very stabilized, 100% occupied. So what is the actual going in cap rate? I'm just trying to get a sense for your smaller markets versus maybe ours here in the States.
That one's about eight cap rate there. And, the other sweet part of that deal is we got 10% vendor take back from the vendor, financing. And we're able to get CMHC financing, which in your area I think it's called Fannie Mae or Freddie Mac or something like that. Mm-hmm. So we have a rate of 2.85%.
Wow.
35-year amortization.
Wow.
Yes, I know. So like I said, the buildings are in great shape. They've been financed by CMHC in the past. So we've got all that. We're actually just supposed to be removing conditions today because we're just waiting for that final commitment letter. But all that kind of stuff just adds up. And when we get those kind of financing deals, like we know we've got ourselves a home run there too. We can pay everybody back just out of cash flow alone. We don't even need to refinance, which makes it nice, meaning our cash flow in a few years out of that building is going to be another 6,000 probably.
Yeah, that's fantastic. I mean, we're actually, it's good that you mentioned that about how you structure your investments for your investors. And the second fund we're rolling out, we've made some slight tweaks to it. And what we've done is, number one, we are not taking any kind of promote until we pay back all of our initial investor capital. But on top of that, we're putting in a 12% clawback provision, meaning that if we don't, on an annualized basis, if we don't hit a 12% cash on cash return on their capital, that they can claw that back from our general partnership side once the promote happens before we actually participate. Yeah, so that way it's pretty much a guarantee. So our carrot, we don't get to take a bite out of that carrot until not only do we pay their initial capital back, but also that we actually have met their expectations as far as the returns.
We haven't done that. So that's interesting. I'm glad you share that. This deal here works out to about a 17% cash on cash return. So yeah, and I mean, we could easily do that, but we never thought of it. So yeah, that's really good to know. Thank you.
Yeah, absolutely. Well, it's just a way to get. It's kind of we're very confident in our ability to find these deals that actually can meet or exceed that criteria. And so us offering that, literally we don't get to feed our families unless we actually hit those parameters. So it's a real carrot, and it's one that we feel very confident in our ability to actually meet and exceed. So
well, and that was one thing I like about the real estate. And, what I learned over the years, because for selling mutual funds for years, we got, and I loved it. I got, it was called a service fee or a trailer fee every month, no matter what, as long as I kept the assets under management, I had a service fee. So I was making at least $10,000 a month without ever walking in the door. And yeah, I mean, you still have to service your clients to a certain extent, but just before I quit, I was down to working 1 day a week and had a full-time assistant or part-time assistant actually looking after my clients. Mm-hmm. So when I moved over into the real estate world, and I seen how most people did it, I thought, it just makes sense. That was one of the complaints people had with mutual funds. Everybody gets paid, the investors are paid last. And people used to say, you know what, Edna, if you could get me 8% return, I'd give you the rest. Yeah. So you know what, that's what people really want. They want a good, consistent return without you making all your money up front and leaving what's left over for them.
Absolutely. Yeah, absolutely. I mean, you're basically the fiduciary of your investors' money. I mean, it's your job, it's your responsibility to ensure that you meet and exceed the returns, right? I mean, they're putting their faith and their life savings in your hands to manage and invest properly. So it's only right, it's only fair.
Yeah.
So I want to talk to you about finding these deals. We were talking about off-market deals. So I want to ask you, and I know you've got many different methods of finding these opportunities, but what are some of the top, I'm going to, aside from your students, the deals that you're doing with students, I'm talking about like your personal portfolio. Mm-hmm. What have you found to be very successful means of finding these off-market deals?
Networking. For example, we've been a member of a real estate investment group now for 10 years, and we're remote members because it's an 8-hour drive from where we live.
Oh, wow.
3-4 hour plane ride. So we usually don't go to the meetings. I've been to a couple, but we're remote members because we've got some perks like insurance, breaks on insurance and different stuff like that. Mm-hmm. Plus, we get some really great education every month through either CDs or MP3s or booklets, different stuff like that. So we're always getting really good education from them. And the fellow that brought the deal to us, he phoned us up, and our name was given to him by a fellow RAIN member who knew where I was from. So knowing I was from this small town, he said, I think he'd approached him because he was in our province, Saskatchewan. And he said, no, you know what, but I know somebody who might be interested. So he phoned us up and actually made us the offer. Never hit the market, and it was perfect. So we didn't have any realtor fees. We didn't have all that big lift that has to happen because of the markets and caps and all that kind of stuff. And love this guy. Like he's great. That even after we got the accepted offer and working on financing, he painted one of the buildings so it looks brand new. Wow. Like you don't have to do that after you got an accepted offer. But he said, we just wanted it all to look nice for you. And they're in there and they're working on it every day and keeping the maintenance up and happy to report that to us,
Isn't that fantastic? So that was the 41 unit deal, right? Is that the one you're referring to? How about some of the other deals that you've done, the other off-market deals? I mean, I guess where I'm going with this is, have you ever gotten involved in like direct mail or cold calling, or has it all just been a matter of networking?
For myself, it's been networking.
That's fantastic.
I've got students, again, that have done a lot of different mailings and stuff like that, staying in contact with other apartment building owners. But I find networking to be the best. If you get around other apartment building owners and you get known as somebody who buys, they come to you first with those deals. So we've got many, many, many deals that have never hit the market. And, we've also done in our area many agreements for sale and bought properties that needed work, either through rental increases or some small renovations, not huge renovations, because we don't have the team for that, but ways that we could force appreciation. So we bought under agreement for sale while the vendor held the financing while we did the work that needed to happen to get it worth the actual low financing with the long-term amortizations that they couldn't do because I wouldn't say they're lazy, but what happens sometimes is after people have owned a building for a long time, they don't realize how much rent has went up and where they're really not staying on top of the market. And so that's how we get our deals. And we just say, hey, you hang on to this. We're going to take the risk. We're going to give you a bunch of money up front, $300,000-$400,000. Then we're going to go in, do our magic. And then, within a year or so, we'll refinance, get you fully paid out. And then that's when we'll have a really solid asset.
Okay, fantastic. So we've been talking about a lot of like the tulips and the roses, all the good, pretty side of this business. I want to talk to you a little bit about some of the challenges that you faced along the way, because as you and I both can agree that there are hurdles, not every day, every hour, every week, every month. I mean, there's always hurdles to overcome in this business, especially when you're just getting started. And so talk to me about, pick one of those big hurdles that you faced when you were growing this portfolio and how you overcame it.
When we first got started, our market was excellent. So our biggest challenges have come in the last little while. So 10 years in, I'm going to talk about one that's actually on our plate right now today. We had our annual general meeting yesterday, and one of our buildings that is up for financing, When we refinanced it, this is one that we bought that needed forced depreciation. It hadn't been updated for years and years and years. So we bought it at $90 a door, put in about $10,000 a door. So we put in new cupboards, flooring, everything, forced that appreciation. We were able to refinance that property at $150,000 a door. Got all our investor capital back. But guess what? The market has changed in that particular city right now. And they're in, even though our location's prime location, we're competing against brand new properties for the same rent that we were getting on these. So when we financed this, we were getting roughly $1,250 for a 2-bedroom a month. And that's what got us the $150 a door refinance. But right now with the market conditions there, we're only able to get about $1,050 for a 2-bedroom.
Wow. Is that a result of things being overbuilt? Are there a bunch of A-class that got built? So now they're giving concessions and basically, okay.
Yeah, a whole bunch of brand new condos were built to sell and they weren't selling. So now they
converted them.
Cool. Yeah.
Yep.
And so that's one thing. That's an issue. On top of that, our lender tells us, we realized that we kind of gave you at the height of the market. We want $550,000. This is 5 years later when our term is up. $550,000 paid down on your mortgage, and we only want to finance the rest.
Wow.
Challenge right now. And so our partners said, you know what, we're not happy with that. We're not going to stay with you. We're going to go look elsewhere. So we're looking elsewhere. We think we'll be able to do way better than that. I mean, we only owe $103,000 a door on those.
Okay, so so you didn't over leverage it, but that's a great point. I mean, because right now, so we're talking two different countries, right? But there's a lot of similarities. I mean, it's North America. I mean, we're connected. I mean, they're different markets, but there's a lot of similarities there. And there's two different classes of investors that exist. And there's those that actually were investing prior to and this is based in the U.S., those that were investing prior to the Great Recession of 2007, 2008, and those that got in when the market was at its bottom here and were buying, and they've only seen the run up the entire time. They haven't seen any kind of slowing or any kind of blood in the streets. And I was investing back prior to the recessionary period of time. And I saw it firsthand, a lot of areas that got overbuilt and where there was a lot of, A-class apartments or condos that were built to be sold that were converted and they were giving concessions. It happened to us, our single family home portfolio even. We lived in an area where there was a lot of speculative homes being built for a population that wasn't necessarily there yet. And when the market started changing, a lot of these builders essentially start renting out these brand new 3-bedroom, 2-bath homes for essentially the same price that we were renting our 2-bedroom, 2-bath, 30-year-old home for. And so we had to take a haircut on our rent. But not only that, we had somewhat of a mass exodus from a lot of our properties because they're like, well, heck, I can go pay the same amount and go live in this brand new place.
Yes.
That happens. And, it's really hard to see that being a potential situation today, at least in the United States. But I can promise you there's certain markets that are in the next couple of years are going to be very close to getting overbuilt with A-class product. And, from the time that the idea to actually, the erection of a building, I mean, you're talking many, many years. And so there's lots of things that are already on the books that are coming out of the ground over the next coming years. And it's like a case of musical chairs in a lot of markets to where you don't want to be the last guy coming to the party, right? You don't want to be the last guy fighting for that chair. And so I'm glad you brought that up because I haven't had that conversation for quite some time with many of the guests on the show. And obviously it's good to see the dynamics of your market and our market. And I know that, again, they're not the same, but they follow very similar trends. And so,
because when you guys were going through your really challenging times in 2007, 2008, that's when our market had
killing it. Yeah.
Doubled it in 5 years.
Yeah.
And like I said, the following year, we got all our money out of the 2 properties that we did put in. So, but you know what, with these challenging times, we've actually had some really great opportunities because we're still buying. And some of my students and I, because we partner, have bought some units where the builders built a whole bunch of condo units to sell and couldn't sell them. So we actually got them through a foreclosure process, again, private deal. And we bought them brand new buildings at $127,000 a door. I think it cost them $140,000 to build them, because they didn't know what they were doing when it came to the rental market. And they just did let anybody in their building just to get it full, and really cheap rents. Yeah. And also brand new buildings were bleeding. So we rescued, got those units. And you know what? We've got those units. We had a couple young guys working with us. They went out there and they filled those units before we financed them. Again, that we did the agreement for sale and the vendor financing. And we got, again, maximum dollar for those at financing, CMHC financing, 17, 18% down, and we're getting great rents, like really great rents.
Fantastic. Yeah. I mean, there's always opportunity, right? If you know where to look, there's always opportunity. Even in the greatest of times, when there's lots of buyers out in the marketplace and it's a seller's market, and the opposite times as well, when there's blood in the streets, there's opportunity to be had, even if it's your own blood that's in the street. there's still opportunity to be had.
What we were thinking, like, even though we have some stuff that's bleeding us right now, we're still buying, because you know what? Real estate's a long-term game. We know that all that stuff's going to come back. We made good decisions when we bought it. It's just a matter of riding the wave and doing what you need to do to keep your buildings on top of things, and buying those bargains that come up, because those are the ones that are going to make you money long term.
Yeah. Well, thank you for being vulnerable and sharing that story. I mean, that's a real challenge. It's a real challenge that you better be prepared. If you're going to be long-term in this business, just expect a challenge like that to occur at some point or another in your real estate journey. So now, and I want to move on to what I like to call the golden nugget segment of our show. And this is where we're going to work on wrapping things up for the day. And you've shared a lot of golden nuggets with us. We've had a lot of great conversation here. But if you had just one last final golden nugget of advice or wisdom that you could leave with our listeners today that may inspire and motivate them as they progress in their real estate investing career, what would that one last golden nugget be?
When you're first starting out, you've got to hang out and partner and be with people who've got some experience. Because there's so many things that can go wrong in real estate. And you know what, especially if you move into multifamily, you don't want big errors. So coach, joint venture partner, somebody who knows what they're doing. Mm-hmm. And the other thing you have to do is be around like-minded people, because you know what, if you listen to the general public, they're all going to tell you, don't buy anything. Don't buy anything. Go stick your head in the sand and stay there for the rest of your life.
I did that. I did that for a couple of years in 2008.
Yeah, but that was probably a good time to stick your head in the sand. But,
maybe not, but yeah, no, I get your point.
Yeah, I see a lot of people. They do that. They don't get around the right people. They maybe get involved in a deal, but then they go home to a negative spouse and parent and brother and everybody else that knows everything, right? You have to be around the people that really know. They know the challenges and they know the upsides, because every single one of us will go through the challenges, and we have to be around people who remind us that, you know what, things don't come that easy. You have to go through the downside to get the upside.
Yeah. I mean, just your case in point of just being a member of a real estate investment group, you might not have anything right in your backyard, but now the internet, I mean, I don't know if Bigger Pockets has a presence in Canada or not, do they?
Yeah.
There you go. I mean, like, that literally is the largest resource for real estate investors to share and share with one another and gain wisdom from each other and share their experiences. I mean, I believe it is the number one forum. I don't know how many members there are now. There's probably a couple million.
Ever been online, but yeah, it's a great one, really great one.
Yeah. Well, fantastic. Edna, this has been so much fun. Thank you again for coming on the show. And for those that want to learn more about Edna and her company and her real estate practices, you can go over and visit her at ednakeep.com. Again, just her first and last name, ednakeep.com. And Edna, that's all we have for today. Thank you so much. It's been an absolute pleasure, and I wish you all the best success in all your future endeavors, and I look forward to catching up with you again soon, okay?
Okay, thank you very much. You take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.